what would you do with a lower mortgage payment? What would you do with an extra $500, $600, $700, $800 a month that you don't have to come up with? You could probably offset your car note, pay off daycare, pay off student loans, pay off debt that you may have, and also invest that money. So if you're interested in actually learning more about how to lower your mortgage payment and how to position yourself in a better place to be able to have a less stress-free life, stay tuned. Hey everyone, welcome to Ask Rinde. I'm Rinde Adebayo, digital entrepreneur, real estate entrepreneur, and top producing agent here in New Jersey. If it's your first time at my channel, please hit the subscribe button and smash the like button. I do videos all the time regarding foreclosure, income, and credit, and I would love to have you as a part of the family. So please make sure that you tap the notification bell to be notified of every time I load a video here. Most people are basically trying to figure out how to actually better survive. And even if they have a job and then they leave the job and go to their quote unquote side hustle, they still can't seem to have the money to be able to pretty much get ahead. The side hustles definitely aren't making them millionaires, at least not everyone that I know of. And so with that being said, I've always come up with ways to be able to help people that are dealing with issues. And one of the main things, which is probably the most important one, is how to deal with lowering their expenses, specifically their mortgage payment. The mortgage payment is most people's largest monthly obligation. And it's a big strain because if you look at this, most people go to work the entire month and their entire life is centered around making income, having a job, having stability, but most importantly, to be able to make their mortgage payment, to cover the roof over their head. That is most of us' biggest, I would say, goal. We want to basically have a place to be able to stay. Most people that I know are not looking to try to be homeless. So most people have a roof over their head, a place that they go to and live. And we fight to basically have the money to be able to cover and pay for that, whether you're renting or you're owning. My audience and people I speak to are people who are dealing with issues that are dealing with foreclosure. While everyone talks about the economy doing very well and everyone seems to have it together, in my opinion, as someone who's getting emails and contact on a daily basis from all around the country, the snapshot that I have is that it's not so. I believe that most people are just surviving. With all the gig economy and all the side hustles and work and the economy rebounding and all of that, what my synopsis is that people are pretty much surviving. They're holding on for dear life in America. And that's an opinion that I stand by, and that is based on having a direct snapshot into what is going on with middle class America right now in this current time that we're in. Not everyone in foreclosure is someone who's gone through or basically has taken the path of negligence. People go through things in life and they need to bounce back, they need to rebound. And the people in the audience that I speak to are people who are basically in distress. So I'm going to share with you today a key way for you to be able to lower your mortgage payment. So in order to understand the process of lowering your mortgage, you need to find out where a mortgage originates and where it starts. And where it starts is whenever a person buys a home, the loan officer or the mortgage broker or banker that closes on the loan, whenever they close on your file and you close and you buy and you get the keys to the house, generally 9 times out of 10, they sell that loan off to what is called the secondary market. The secondary market has buyers or investors that buy these loans. The biggest buyer of mortgages in America is Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are government-sponsored enterprises that basically buy mortgages. They're the largest buyers of mortgages in the U.S. So generally what happens is Freddie Mac or Fannie Mae buy these mortgages, and what they do is they then pool them together with other mortgage-backed securities and then sell them off to investors. So what happens is your loan then goes from the originator, who is whoever closed on the loan with you for you to buy the house, over to the secondary market. Or what they'll do is they'll hold on to it and basically keep it and process the loan on their books. But generally what happens basically is that they'll sell it off to investors. The key thing about Freddie Mac and Fannie Mae is the fact that because they're government-sponsored enterprises, they guarantee their loans. So what happens is investors, private investors, feel secure buying those because what happens is that in the case of a default, you default on the property or someone who purchased the property defaults, they're still guaranteed to get paid. This is the backdrop to the whole mortgage industry, where when you find these investors crying and going to court with people and saying that, oh, well, they haven't paid in 5 years and all these issues, these guys have made their money and the money is secured. Generally, if you look at the loans, most loans, the interest alone, it covers what their actual note is. So taking it further, either way, no matter what happens, the borrower defaults, the investor gets paid. They're guaranteed. So needless to say, Freddie Mac and Fannie Mae play a key role in the mortgage market. And so with that being said, there is a program called the Flex Modification Program that's established. And so if your loan is owned by Freddie Mac or Fannie Mae, then you have the ability and the eligibility to apply for what is called a Flex Modification, a Flex Loan Modification. So this has been around, we've known about it for about a few years now. It's been around since 2016. And the Flex Modification Program replaces what is now the defunct HAMP program, the Home Affordable Modification Program. But the reason why they call it Flex is because it actually combines all the modification programs that Fannie Mae and Freddie Mac offers, which is the HAMP, the Streamline, and the basically traditional, just straight up loan modification that they offer. Now, the Flex Modification Program can actually be applied for if you are not even in full default, meaning that you can be 60 days behind and still apply for this program. And the goal with this is that they target reducing your mortgage payment by 20%. So let's just say, for example, your mortgage payment is $3,000. 20% will be $600. And so that brings you down to $2,400 for a mortgage payment. But let's say your mortgage payment is $2,400. 20% is $480, which would bring your mortgage payment down to $1,920. Just look at these numbers. What could you do with $600, an extra $600? What could you do with an extra $480 a month? That's a lot of money for some people. I mean, if you think about it, if you have a car payment or if you have daycare for your children, expenses that are hundreds of dollars a month, this could be a game changer for you. And so sometimes I share with people all the time, it's not necessarily a hopeless situation when you fall behind, because what happens is that when you know the tools and you have the knowledge and the strategies and the creative ways that we've been able to help people save their homes, stop foreclosure, and all these things, it's kind of like seamless. It's kind of like holding something that is like the Holy Grail. I've gone through a lot of wars regarding the knowledge that I've gained over the years and fighting and realizing, coming up with these strategies and these solutions and ways to help people and basically help myself, And so with the target that they have of 20% savings is basically worth it, you trying and applying to be able to try to get this flex modification. Now, there are rules and there are things that you are required. Now, if you're 60 days delinquent or behind, you definitely can apply. They will require you to fill out a complete loss mitigation application. And also, they are looking for a 40% expense to income ratio with the people that are 60 days behind. If you're 90 days behind, you have to be in a window of 90 to 105 days. And in that case, you can definitely apply, but they don't necessarily require all the income documentation that you would require as if you were in a 60-day window of default. The thing about this is that it's always going to be income-based when you are applying for any loan modification. Fannie and Freddie offer this to people who have their loans with them. But what happens is, in the case where these servicers that are working for Fannie and Freddie, if they're able to offer this to you and they see that you don't qualify, then what happens generally is that they'll switch you over to what is called a proprietary loan modification. Keep in mind, with a loan modification, there are tiers, okay? There are things that you have to actually consider when you are applying, because it's just like you're applying for the mortgage to be altered. Generally, what happens basically is that the first thing that they'll look at is capitalization. Capitalization is when they actually will take the arrearages and put it on the back end of the loan. They're also going to be looking at basically in lowering your interest rate. Now, lowering your interest rate, that is a caveat, because what happens basically is that if you're in a situation where your interest rate that you have right now is low, but the current market and the interest rate is high, they may not look at that option, because then they will be taking you up higher instead of lower. The other things that they could offer to you are what is called a Forbearance Agreement, and then they would take the arrearages, put it on the side, and then calculate a mortgage payment for you offer it to you. But the key is that the money that you actually have been put on the side will be due when the property is either refinanced or sold. Sometimes people forget about this, and I can tell you there's been nightmare situations that we've had to deal with because of that, people just forgetting the fact that there was a forbearance done and they'd have to repay that money back. And so this is available for you if you like to figure out how to proceed and figure out how to actually apply for a flex modification and get your mortgage payment lowered and get yourself in a better position. We can certainly help you with that. Connect with us. Get started by clicking the link below. Also, if you'd like to get all my income hacks regarding how to make money while you're in foreclosure and also lower your mortgage payment, go to my website, foreclosurehacks.com. Inside, I give you my hacks regarding income and how to actually get income while you're in foreclosure, which is basically the game changers, the holy grail, is what everyone needs while they're facing a situation. Just keep this one thing in mind. The mortgage company that you're making your mortgage payments to monthly, they're not the final decision maker. There is an investor that is behind that actually owns that loan, and they are just the servicer for that. They're just working for that investor. That investor could be somewhere in California, basically in his shorts and his laptop, sitting up with his feet up and making a decision. So when you apply for a loan modification and you're asking for your mortgage payment to be reduced, you're asking for forbearance, you're asking for a repayment, that is sent over by the servicer over to the investor. And basically he's on his computer, he's making a decision, yes or no, or his office is doing it for him. And so just keep that in mind, because we know who the players are and the investors that are backing a lot of these loans from the secondary market on Wall Street and elsewhere. We know some of them, what they'll do and what they won't do. And so there's a whole world that goes behind the mortgage market. And when you see or you run into a situation and you need help and you're dealing with the bank, understand that the servicers generally are working for investors that they're working on behalf of. And so you have to know the pain points and what to do and what the investor will do and what they won't do. And so if you'd like more information and you need help regarding filling out, starting the process for a flex modification and knowing how to do it and how to go about it and see if you apply, you can definitely check to see if your loan is with Fannie or Freddie by using their online tools and basically seeing if your loan belongs. And you can also call the servicer and find out if your loan is with Fannie or Freddie. If you need help to basically start that process, please go to my website, AskRinde.com, and get started today. And I look forward to seeing you. We give videos all the time regarding foreclosure, income, and credit, and I look forward to growing with you all. Until next time, thank you for joining me.